Management Studies IGNOU presents an audiobook on the course MMPC 003 Business Environment for MBA program. Presenting Block 4 International Business Environment, Unit 10 International Financial System, Part 2. World Bank Group Institutions. Number 1. International Development Association, that is IDA. This arm of the bank looks after the poverty alleviation and debt relief of majorly the 74 poorest countries of the world. They lend money on concessional or near zero interest rate terms. The loans are made for long-term 30 to 40 years with interim 5 to 10 years grace periods. The debt relief is done through two initiatives called Heavily Indebted Poor Countries and Multilateral Debt Relief Initiative. The institution provides a range of assistance to promote economic growth, equality, employment opportunities, higher income and enhanced living standards. Major areas covered under the Institute's initiatives are primary education, basic health services, clean water and sanitation, agriculture, business climate improvements, infrastructure, and institutional reforms. Number 2. International Finance Corporation, that is IFC. This arm of the bank is involved in private sector development in member countries, especially those projects which have welfare implications. The institution can help private sector entities by giving loans, taking equity stakes, stock options, or by sharing profits. It may also provide venture capital and stimulate investments by other private entities and overall try to develop the capital market in developing countries. This is meant to foster private investment flows both within and across borders. The funds for these programs are sourced from the institution's net worth, retained earnings, public and private placements of bonds, and from the bank. The major thrust has been to increase efficiency of public utilities through push towards privatization of such services. Services like power, water, transportation and communications have been targeted for this purpose. In terms of technical assistance, the institution tries to help private sector entities to get select technology partners, find markets for their products, and sources of low-cost finance for their expansion. Number 3. Multilateral Investment Guarantee Agency, MIGA. Foreign investments are an important source of funds for fueling economic growth and reducing poverty in developing countries. Observed foreign flows shows appetite for only a handful of such countries, severely limiting the prospects of growth and development in countries facing internal or external problems related to the political atmosphere. MIGA comes in here and tries to channelize foreign investment in disturbed and poor countries through its initiatives. The most important of them is the political risk insurance products, which can be bought by the investing companies to guard them against any problems which makes their investment bad in host countries. The agency also provides services like technical assistance to promote investment climate, settle investment disputes, and promote foreign capital flows in disturbed countries who need them the most. The Independent Evaluation Group, that is IEG-MIGA, was established in the year 2002 to assess MIGA's operational and developmental effectiveness. Activities to be evaluated include guaranteeing projects, technical assistance, advisory and legal services, as well as the evaluation of MIGA's institutional efficiency, efficacy, and strategy. International Center for Settlement of Investment Disputes, that is ICSID. ICSID gives a platform for the investors to settle their disputes with the host states. A need was felt for tackling the non-commercial risk of foreign investments. The members involved in the dispute can voluntarily resort to the mechanisms available with ICSID to settle their disputes. But once sought, they cannot withdraw from the proceedings. Additionally, over the years, given the request by the members, ICSID may also involve itself with the fact-finding missions related to the disputes. It now also allows cases if one of the countries involved in the dispute are not its member. Additionally, it may also involve in transactions which cannot be categorized as foreign investment but is distinct from an ordinary commercial transaction. An example can be fact-finding proceedings. Further, the Secretary General of ICSID is available for appointing arbitrators or disqualifying them for disputes covered under their conventions. ICSID provides well-equipped hearing rooms for the proceedings related to disputes. International Monetary System. The nations transact with each other mainly through trade and capital flows. Net transactions have to be settled at regular intervals. While engaging in such transactions, some of the countries may face situations where the payment obligations are more than their receipts. In that case, such disequilibrium in balance of payments is either met through foreign exchange reserves or through borrowed funds. Hence, there is a requirement for countries and institutions to act as supplier of such reserves. Amount of such reserves that would be demanded depends on the speed of adjustment of balance of payment and the institutional framework of the world economy. Exchange rate system followed by the countries also impacts the amount of reserves that can be demanded. In a completely market-determined exchange rate system, the movement in exchange rate brings the balance of payment back to equilibrium, reducing the requirement for international reserves. In case of a fixed or pegged exchange rate system, in order to maintain a certain level of exchange rate, the requirement for foreign exchange reserves increases. The other function of international reserves is to facilitate government intervention in foreign exchange rate markets. Higher the volume of such activities, higher is the requirement of international reserves. The other major factors impacting the demand for international reserves are the speed of automatic adjustment, policy aimed at restoring balance of payment equilibrium, and international coordination of economic policies. If the automatic adjustment mechanism takes time, then the demand for international reserves goes up. For example, a balance of payment deficit triggers a depreciation of home currency which enhances exports and reduces imports and automatically moving the country towards equilibrium. But if rigidities cause the adjustment to be slow, then the country has to resort to international reserves either owned by them or borrowed from others. Similarly, if the economic policies geared towards restoring equilibrium takes time to achieve the desired outcomes, again the demand for international reserves goes up. The coordination of economic policies across countries has been the objective of institutions like IMF. Groups like Organization of Economic Cooperation and Development (OECD) and monetary unions like European Union are efforts towards this direction. More the coordinated are the economic policies across countries, lesser would be the need for international reserves. The supply of international reserves can be owned or borrowed. They are majorly in the form of gold, acceptable foreign currencies, and special drawing rights, that is SDRs. Gold has always been a major form in which international reserves were kept. During the years of the gold standard system, that is, from 1880 to 1914, gold served as a means of payment, unit of account, and store of value. The national currencies were denominated in terms of gold, and since its supply was not that flexible, it disciplined the central banks in the sense that excessive money growth was not possible. Countries stood committed to exchange gold for their currencies freely. The importance of gold in money supply, however, drastically came down before World War I, and the importance of paper money and demand deposits in banks increased manyfold. At the end of World War I, when inflationary tendencies were high, there was a demand to return to the gold standard. US was one of the first countries to announce the return to gold standard. But it turned out to be an uphill task, and due to the onset of Great Depression, it was no longer possible to maintain the system, and countries one by one abandoned the gold standard. After the World War II, when IMF came into being, the world moved on to what is known as the gold exchange standard. Gold was considered as a unit of account. US took the responsibility of being the international banker. Dollar was denominated in terms of gold. All other currencies were denominated in terms of gold or gold content of dollars. US agreed to freely convert dollar to gold whenever presented with the currency by the other countries. Dollar thus served as a reserve currency. The system was perfect till the time US gold reserves were higher than outstanding dollar liabilities. But as gold reserves fell short of such liabilities, fear crept into the minds of the countries holding dollars that the US might devalue the dollar, leading to losses for them. On 1st January 1975, gold was abolished as a unit of account and could be freely traded by countries like other commodities. Use of gold was discontinued by IMF. Recent data shows that the percentage of international reserves kept in terms of gold is less than 1%. Given the expansion of international trade and capital flows, dollars and gold was found to be inadequate to serve as international reserves. The need was thus felt for an additional international reserve currency. SDRs were contemplated as a unit to decide the contribution of their members to IMF. The value of SDRs was determined by the basket of acceptable currencies like dollars, yen, pound, and euro. The proportion is decided on the basis of trade in these currencies in the last 5 years. SDRs are not claims on IMF but on the countries which issue the acceptable currencies, on the basis of which value of the SDRs is determined. Countries holding SDRs can freely convert them into these currencies. The nations can access international reserves from two special windows of IMF. One is the IMF drawings. In this, the nations in need of international reserves can buy foreign currency by pledging their home currency and agree to buy them back at some future date. This is normally extended till 50% of the quota for that country is reached. Additional amounts can be accessed through special permissions. The second option is to access credit through IMF's general arrangements to borrow. G10 countries agree to give additional funds to IMF to finance this facility. This is over and above the amount accessed through IMF drawings when the latter is found to be inadequate to finance balance of payment deficits. Now let's summarize the unit. Process of globalization gave rise to the need for an orderly financial system. The IMF and the World Bank can be seen as institutions which were created for maintaining a stable international financial system. Specifically, IMF was entrusted with the job of assisting nations in payment problems. In return for such assistance, the countries were supposed to follow prescribed policies. Such policies, while successful in some countries, created further problems in others. The World Bank majorly looked at assisting countries in reducing poverty. Private enterprises in such countries were also encouraged through assistance from IFC, an important arm of the bank. The current role of IMF is more flexible than in the past and is seen as more conducive for the developing countries. The World Bank, on the other hand, is engaged in poverty reduction and helps build smart infrastructure in developing countries. Countries thus have means to stabilize their financial system and address poverty-related problems which may be beyond their capacities to tackle. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 002 Human Resource Management. Course Coordinator Professor Nayantara Padhi from School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Jagbandhu Jana. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.